now we're going to take a look at in the money bull call debits, risks during the trade, and criteria potentially to use. This question comes to us via email from Terry. Terry says, I would love to see an example of a deep in the money call debit spread and what the loss risk is and how to find good tickers to use for the strategy. Currently uses Thinkorswim to analyze the graph, and he says it really does nothing for me. I just can't understand the chart. Well, I'm going to try to help you with that. I'm not going to make any promises, but I'm going to do my best. Well, not using TOSs. I'm going to use mine, and hopefully that can translate over to TOS for you. The only way I can see if the trade loses if the stock price falls below the shorted strike. Not exactly, but technically you're not too far off at all, Terry. Here's a trade found using our weekly bull call debit default search. FUTU is trading at 145.09. This was roughly at around 3 o'clock this afternoon, I think. And what came up on the search was I could sell to open the June 136 call, June 18th, only 7 days away, for 10.75. And then at the same time, we buy a deeper in the money call, the June 134 call for 12.20. Now, this would give us a net debit of $1.50 for this spread. It's only a 2-point spread. So the maximum return we could get at expiration, if the stock stays above those strike prices, we get the full difference in strike prices back to $2. We'd make 50 cents on a $1.50 debit, so a max profit of 33%. A break even for a debit spread, whether it's in the money, whether it's out of the money, is the net debit you paid plus the long call strike price. So in this case, it'd be 134, the call that I bought, the lower strike call, plus the $1.50 debit. My break even is at 135.50. So the stock can fall below the short call strike price, Terry, and I'm not necessarily losing yet at expiration. Once it goes below that break even, now my long call is worth less than the intrinsic value. I'm sorry, less than the break-even point that I'd need. Remember, 135.50. I need that $1.50 on my 134 strike to not lose any money. And in that case, once it goes below, let's say it goes to, 135, I only get $1 back, so I'm losing 50 cents on the position in that case. Okay? Now, the max loss does occur if it drops below both strike prices. That's the blue profit, our little hockey stick profit and loss chart. That is the maximum loss. Losses occur below the break even at expiration. Now, this position has a 6.3% range out of the money. That's for the short option. That's what we focus on with the delta, the probability, and so forth. I'm looking for a probability above at 76.8%, a little bit lower than I would go for most of my vertical spreads, weekly in the money debit spreads or weekly out of the money bull put spreads. I usually like to go to 80 to 85%, but that's okay. That's just an example. And of course, the delta of the short call is 0.78, and the delta of the long is 0.839. Now, that in itself doesn't mean that's a criteria I'm going to use. We're going to talk about the criteria in just a few moments. Why I'm showing this is so we can talk about the profit and loss chart. We sort of already covered this, but let's look at it more in depth a little bit. There's two lines here. The blue hockey stick graph, Terry, that's at expiration. We hold this position all the way to June 18th. If the stock's above our sold option, we make the maximum profit. Whether it's at 140, whether it's 160, whether it's 210, we make that max profit of 50 cents on a $1.50 for the FUTU trade and 33% return. We get back the difference in strike prices. That's the best case scenario. I leave it through expiration. If both calls are in the money, I let my broker buy shares of stock for me at 134 at the call option I bought to deliver the obligation I have at 136. I get 2 points back. There's my max profit. Remember, the break even is 135.50. I paid $1.50 to get into the position, so I at least need this long option, which is technically my investment. I need that to be at $1.50. So anywhere below 135.50, we start losing a small amount of money, and max loss occurs when we're below both. What is this curved red line showing me? Even though expiration's out to 6/18, this curved red line is showing me the profit and loss at the halfway point. halfway between now and expiration, which would be June 16th, even if the stock is above both of my strike prices, I could be at a loss as the stock falls. And why does that happen if they're both still in the money? Well, they both still have time value. And as the stock starts to fall, both options are decreasing. But remember, with the delta, the short option is losing about 0.78 cents. This is the obligation I have to buy to close if I got in trouble, right? This is what I have to pay. And it's losing 78 cents roughly for every dollar the stock drops. My deeper in the money call, the 134, has a higher delta of 0.84. So for every dollar the stock starts to drop as we get closer to expiration, yes, delta is ever changing, but right now I'm essentially losing 6 cents on my spread debit that I paid every dollar the stock's dropping, and it can cross into the loss prior to expiration, naturally. That's what that curved line is showing. The stock price is up here, of course. We know anything above the sold option is full profit at expiration. Anything down here is max loss. It's not just below the sold option that starts to lose money. It's below the break even, unless you had a really, really close to intrinsic net debit because you were very deep in the money. Then, if you paid, I'm sorry, this is a 2-point spread. If I paid $1.90, because both these options were a delta of 0.95 and 0.97, I was really deep in the money. Then yes, just anywhere below that sold option, 10 cents below the sold call strike price would be a loss for my position in that case. Another factor that's occurring here is what we always talk about, the ATM bell curve. And as the stock is falling, my sold option, which is my obligation to buy back, that I have to pay to close, is seeing a swell in extrinsic value. You look at any option chain, the option that's right at the money has the highest time value of any of the options in the same expiration cycle. So as this stock is falling, this option went from out of the money to closer to at the money as it continues to move down. And even as time's passing, we're seeing an extrinsic swell because the at the money bell curve. And as the stock's falling, we're losing the delta because we're losing more on the long than we're losing on the short that we have to buy back. We start to drop below the initial net debit price. Liquidation value is dropping below 150. And we are at a loss on the position. We start to lose on the spread. Now, is that really important for what you asked? Well, let's take a real world example. And we're going to take a trade from June 2nd for the 18th expiration for next week. This was not in our search from the bull call debit spreads. I actually looked on the bear call credit spread search and found a stock that had the trend that I wanted, so we could use an example of what happens to a declining stock in a bull call debit spread. On June 2nd, iRobot, IRBT, was trading at 105.93. We could have sold the June 95 call for $12.10 and bought the 18th June 90 call for $16.45. This is a net debit of $4.35. It's a little bit lower than our example, but it's around the target range I would look for an out-of-the-money bull put spread 2 weeks out in time, or an in-the-money bull call debit spread. 15-16% return, somewhere in that wheelhouse. It's a 5-point spread. We pay $4.35, so if you get the full 5 points back, $65 on $4.35, that's our 14.95 return. The break even, of course, is going to be 90 plus the $4.35, so our break even's at 94.35. And as you can see, the stock has not performed well. This profit and loss chart was made today using the numbers from June 2nd. We can see the stock's trading at 95.55. But initially, when this position was opened, the delta on the short was 0.84. So we're close to what I'd look for an 82, 83, 85% probability above in this case. But it doesn't always work that way. Here's what happens over the last 9 days, since June 2nd, excuse me. It cropped it off here at the bottom, I apologize, but that's June 2nd. And the peak and the close was around 106. June 3rd, the stock closed at 99.99. Remember, we're holding the 95 short, and we bought the 90 long. On June 4th, 97.55. We're down about 9 points from where we were, a little bit lesser. Now on June 7th, get a little bit of a reprieve, and on June 8th, we're looking great. Things are going back to normal. On June 9th, it falls another 4 points, goes down to 96.87, and on June 10th, we close below the short call strike price. And at 330, 345 today. iRobot was on 95.95, so it moved up another $1 or so from where we got in. And the current liquidation value at that time, if I sold to close the long and bought to close the short, I'd only get 330 back. Remember, the debit was 435. So even though the stock's above my strike price now at 95.95 with 5 days to go, I'm at a loss on this position of 24%. That doesn't mean that's a trigger for me to close it. But we wanted to kind of impress upon you, Terry, that in addition to looking at how the profit and loss chart performs and where the break even is and what the expectations are when max loss occurs, and it's not just anywhere below the short call is a loss in a bull call debit spread. You want to focus on the break even. But during the trade, because of the time value that remains, as the stocks fall because of the at-the-money bell curve, and also mainly because you're losing more on that long option, which is your investment, because it has a higher delta being deeper in the money. And in that case as well, we're still not losing as much on the short option because it has a lower delta, and that's the one we have to buy back. But it's important to note what happens during these trades, not just about break even, not just about closing at break even if the stock hits the break even price. Anytime you're doing a vertical spread, you want to set your triggers to protect yourself, because you never want to take a 60, 70, 75, 80, 100% loss on any spread. That's going to throw your whole trading plan out of whack. We have other presentations where we talked about that, even ones from last week, as a matter of fact. Now, here's what we have. Okay, that first day when we opened it, well, we knew that we paid initially 435 into the position, and this is using closing prices, of course. So I had to go back historically, and we're at zero gain or loss essentially. On June 3rd, when the stock fell to $99.99, it was down $5.94 from the open. The liquidation was $3.65. Even though we're still in the money, we could only get $3.65 back. So we're at a loss of 16%, 70 cents on day one. Some of that's due to bid-ask spread, but as you can tell, most of it is due to this. What happened? It moved down about 6 points. Where's the 70 cents? Remember my delta difference. It's 0.7. I'm sorry, this one was 0.84. I apologize. It was 0.84 and I believe 0.92 or 0.93. So for every dollar the stock dropped, in a sense, I'd expect to be given, 6 or 7 cents back. So with 6 points down, it's a little bit more than that, but we're also seeing some of that extrinsic ATM bell curve because it's getting closer now. It was a full 2 strikes, or 95 strike, was a full, 2 strikes out of the money, essentially, to the 100 to the 105. Now it's only 1 strike out of the money. In the money. I'm sorry, I'm thinking of bull puts. It's only 1 strike in the money. I'm sorry. Next day, 97.55. Didn't hurt too bad, but we're about a 20% loss on the position. Get the recovery on 6.7. Now we're only down 13.8%. Get that big jump back, and we're almost back to break even. We're only down 30 cents if we liquidated the spread. Still 10 days to go to expiration. We're still looking at a loss of 30 cents here, 6.8%. And then it throws us for a loop again. It comes back to 96.87. Now we're at a 33% loss on the trade. And then the next day, when it dropped below the short call strike price, yes, it came back today, but it dropped below the short call strike price, and we're at a 45% loss on the position. Why is that important? Because most investors who trade credit spreads or debit spreads, myself included, usually have a limit that if the stock reaches within 1% of the short call strike price, short option strike price. Now, this is for out of the money credit spreads with a high probability, and out of the money credit spreads with a high probability, or in the money debit spreads with a high probability. There are management techniques. We're not going to go into those today. We're not going to go into this in this presentation. But the triggers you always hear me talk about on those full webinars on exit strategies and 8 ways to manage a bull put spread are the same things I would use for a deep in the money bull call debit. The stock reaches within 1% of my short put strike price, which in this case would be 95.95, essentially where we are today. 1%. Why 1%? Well, I started this position almost 6.5% out of the money. It's going the exact opposite direction I want. and now I'm at only 1% in the money for the bull call debit, 1% out of the money for the bull put credit if I entered it that way. That's telling me that things are going wrong. If I hit that 1% rule and my trigger to close is 45 to 50%, I usually exit the position. Why? Because I can't risk it going to 60 or 70%, because then that'll adjust your whole trading platform and you won't be able to be successful, your whole trading plan in that case. Now, today it does come back up, but it's only at 24% loss. And I might have taken a loss on this one, to be honest with you. In this case on 610, because it likely hit my triggers at some point during the trading day where it was at a 50% loss in the position. And, we have full webinars. I'll get to that later on in the presentation. We have full webinars on managing debit spreads and credit spreads. But at some point, if the position's going against you and you're at a 50% loss, it might not be worth managing it. Take the 50% loss, move on, and find a better position where you're targeting your 12, 15% return. Because this 50% loss you're seeing now, if you try to roll it down or you try to make an adjustment that's based on you think it's going to recover and it continues down, now you've locked in the 50% loss in the first trade and you're losing 40 or 50% on the next trade. You don't necessarily want to do that. It's not always the best approach just to try to keep managing these positions. There are ways to manage it, but you don't want to keep doing that. All right, so why I wanted to share that again was just to show Terry that you have this break even at expiration, but you've got to pay attention to what's going on during expiration. We wanted to run through an exercise of how a spread will perform on technically a day-by-day basis as it starts to move against you. Credit criteria for the ITM debit spread, shorter time frame, you're going to be under 30 days out in time. Your targets might be different. If you're looking for a 90% probability or a 0.9 delta on your short call, your return minimum is going to be 5, 6, or 7%. You go to the 80 or 85% range, you're going to be targeting 10, 12, 15% returns on the position. I use probability. You can use delta, 0.8 or higher. You don't need to worry about how far out of the money you are. The delta and the probability dictate that for you. You're probably going to be 6, 7, 8% out of the money for a 1 week out or 2 week out trade. Mine was a 2 week out trade, so 80, 85% probability puts you at 6, 7, 8% range out of the money. You'd want to look for some volume and open interest. And depending on your preference, I usually prefer to look for strike differences that are 2 points apart or higher. I don't like to play the 1 point spreads or the 50-cent spreads. Personal opinion, and having a strike in between actually allows me to get a different management technique for those positions. Stock position. Same as any neutral to bullish, which we already covered in the first 25 minutes of the presentation. I want to stock in an uptrend above a 20-day or 50-day moving average. I'm probably going to look for a positive MACD, seeing a positive MACD crossover at least 2 to 3 days. Avoid earnings. Any vertical spread, I don't care how deep you are in the money, or if you're using at the money debit spreads, that's irrelevant. You want to avoid the earnings between now and expiration. You might want to look for a positive earnings per share growth to reflect a good managed company, good average stock volume, maybe 700, 750,000 shares on average traded per day. And of course, anything you might use to find a moving up, stable, technical, or fundamental. So any criteria you use is what I mean. If you're looking for a stock that you might be interested in buying for growth, any criteria you might use for stock that you're looking for that's stable and a growth, or a strategy that's stable or growth, whether you use stochastics, whether you use Fibonacci or anything, use those. Keep the trend that you want for the strategy. Don't bottom feed. I've run different examples for married puts and even for slightly out of the money, I should say, bull put credit spreads. And the idea is, hey, if a stock is bouncing off its lower Bollinger Band as near as 52-week low, it has to come back up. Yeah, what I've seen is only about 40 to 50% time that happens. The others keep going down or stay down in that lower range. Highest implied volatility is not always the key in a spread. Because remember, a spread is one of those leveraged positions where you could potentially lose 100% of what you invested. High implied volatility options mean that there's something on the horizon that the market's expecting that could cause the stock to fluctuate in a fair amount or by a fair price shift soon. It could go in your direction or it could go against you. Yes, the higher implied volatilities might give you a higher return, but it's also pointing you to there's something on the horizon the market's expecting in this case that could cause a problem. Okay, so the search criteria, we just reviewed what I would typically look for. Alton had earlier asked a question about your thoughts on debit. We're going to go into his questions a little bit more in just a moment, but your thoughts for credit spreads versus debit spreads in this case. And, it's a varied thing. But on PowerOptions, whether you're doing bull puts, whether you're doing bull call debits, you can use our defaults in the search as a stepping stone to create your own personal search. And as I mentioned, this is the defaults here for the bull put credit spread, the weekly bull put credit spreads, just going 8 to 14 days out in time. Return of greater than 9%. We target an average of around 14.5%, 15%. Strike difference greater than 2, as I mentioned, but most importantly, probability is greater than 85. And all the positions I have are going to be 6, 7% out of the money. In that case, I don't need to put that in because the probability is doing it. But you can also filter by delta if you prefer to do that. Looking for a stock above the 20-day moving average, positive MACD, crossing of the signal line of at least 3 days, and no earnings between now and expiration.